You don't need a hedge fund. You don't need options, futures, or some secret stock picking system. In the next 10 minutes, I'm going to show you a portfolio so simple you could set it up on your phone during a coffee break. And historically, it has outperformed most people who actively trade their own money. Not because it's clever, because it's boring. And boring, it turns out, is exactly what wins. Stick around, because by the end of this video, you'll know the exact allocation, the one rule that keeps it running on autopilot, and the small mistakes that quietly wreck most investors' returns. Let's start with a story you've probably lived some version of. Someone opens a brokerage account. They're excited. They buy a stock because a friend mentioned it. It goes up 10% in a week, so they buy more. Then the market dips, the stock drops 15%, and panic sets in. They sell. A month later, the stock recovers and keeps climbing without them. This isn't a rare story. It's the default story, and there's actual data behind it. Research firms that track investor behavior have found something remarkable for decades. The average investor earns significantly less than the very funds they invest in. One well-known annual study on investor behavior has repeatedly shown a gap of several percentage points a year between what the stock market returns and what the average fund investor actually keeps in their pocket. How is that even possible? If you put your money in a fund that returns 10% a year, shouldn't you also earn close to 10%? Here's the catch. That 10% is the return for someone who stayed invested the entire time. Most people don't. They jump in after a rally when prices are already high. They jump out after a crash when prices are already low. Buy high, sell low, again and again, is the accidental strategy of the emotional investor. Let's break down the 3 most common mistakes. Mistake 1, chasing performance. A stock or sector has a great year. It gets talked about everywhere, and new money pours in right at the top. Then it cools off, and the latecomers are the ones holding the bag. Mistake 2, panic selling. Markets fall. It's uncomfortable. Watching your account balance drop feels like watching money disappear. So people sell to stop the bleeding. But selling after a drop locks in the loss. The people who stayed invested through past downturns were the ones who captured the recovery. Mistake 3, overtrading. Every trade has a cost, a fee, a tax event, or simply the mental energy of constantly checking and adjusting. Studies on brokerage account activity have consistently found that investors who trade the most tend to earn the lowest returns, not the highest. More activity does not mean more skill. It usually means more noise. Now, here's the part that surprises people. You don't need to outguess the market to beat most of these investors. You just need to avoid these 3 mistakes. That's most of the battle already won. So, what do you actually do instead? You build something simple enough that emotion has nowhere to grab hold. Let's build it together, piece by piece. The core idea behind this approach is diversification. Not owning one stock or even 10 stocks, but owning small slices of thousands of companies at once, spread across different types of assets. When one part zigs, another part often zags, which smooths out the ride. A classic simple version of this looks like 3 main ingredients. Ingredient 1, a broad stock market fund. This is a single fund that holds a slice of the entire stock market. Thousands of companies, from huge household names down to smaller growing businesses. Instead of betting on which company wins, you're betting that businesses as a whole tend to grow over time. Ingredient 2, a broad bond fund. Bonds are essentially loans to governments or companies that pay you interest. They tend to be more stable than stocks and often hold up better when stocks are falling. This piece is your shock absorber. Ingredient 3, optional but common, an international fund. This gives you exposure to companies outside your home country, so your entire financial future isn't tied to the fortunes of just one economy. A widely used starting mix looks something like this: a majority in the broad stock fund, a meaningful slice in the bond fund, and if you want extra diversification, a portion in international stocks. A common shorthand version, sometimes nicknamed the 60-40, is 60% stocks and 40% bonds. Younger investors with decades until retirement often lean more heavily into stocks, since they have more time to ride out the ups and downs. Investors closer to retirement often shift more toward bonds, since they have less time to recover from a downturn. There's no single perfect number here, and I'm not going to pretend there is. What matters far more than the exact percentage is that you pick a mix you can actually stick with. Because the investor who stays invested in an okay portfolio for 20 years will almost always beat the investor who jumps between perfect portfolios every few months. Now, here's the part that makes this whole thing work almost automatically. Rebalancing. Over time, your portfolio will drift. Say you start at 70% stocks and 30% bonds. Stocks have a great year, and suddenly you're at 80% stocks and 20% bonds without you doing anything. Your risk level has quietly crept up. Rebalancing simply means selling a bit of what's grown and buying a bit of what's lagged to bring your mix back to your original target. A simple rule many people use is to rebalance once a year, maybe on a birthday or a fixed date like January 1st, or whenever an allocation drifts more than 5 percentage points from its target. That's it. Once a year, check the numbers, adjust if needed, and walk away. Why does this work so well? Because it forces a version of buy low, sell high, automatically, without emotion. When stocks have surged, rebalancing trims some of those gains and moves money into the assets that lagged. When stocks have fallen, rebalancing nudges you to buy more of them while they're cheaper. You're systematically doing the opposite of what panic tells most people to do. Historically, portfolios built this way, broad, diversified, and rebalanced on a simple schedule, have captured most of the market's long-term growth while smoothing out some of the roughest drops. You're not trying to beat the market, you're trying to become the market and let time do the heavy lifting. Okay, so the idea makes sense. Now, let's talk about actually putting it into practice, because this is where a lot of good intentions die in the details. Step 1. Pick the right account first. Before you even choose your funds, choose the right container to hold them. If your employer offers a retirement plan with any kind of matching contribution, that's usually the very first place your money should go, because that match is essentially free money added on top of your investment. After that, tax-advantaged retirement accounts are typically next, since they let your investments grow without being taxed every single year along the way. A regular taxable brokerage account can come after that, for money beyond your tax-advantage limits. Step 2. Choose low-cost, broad funds. This is where fees quietly matter more than most people realize. Every fund charges an ongoing fee, often called an expense ratio, expressed as a small percentage of your investment per year. A fee of 1% might sound tiny, but over several decades that difference compounds into a significant chunk of your final balance, because you're not just losing that money, you're losing all the growth that money would have earned. Broad index-style funds tend to carry some of the lowest fees available, often a small fraction of a percent, which is one more reason simple tends to beat fancy. Step 3. Automate your contributions. Set up an automatic transfer that moves money into your investment account every payday before you have a chance to spend it or second-guess it. This does two things. It builds the habit without relying on willpower, and it naturally practices something called dollar-cost averaging, buying a little bit at regular intervals regardless of whether prices are up or down that week. Over time, this smooths out the impact of trying to guess the perfect time to invest, which, honestly, nobody can consistently do anyway. Step 4. Set your rebalancing date and protect it. Put a reminder on your calendar. Once a year is plenty for most people. On that day, look at your allocation, nudge it back toward your target if it's drifted, and then close the app. The goal is to check in like a scheduled maintenance appointment, not a daily habit. Checking your portfolio every day tends to make people more anxious and more likely to make an emotional mistake, not less. Now, a quick word on taxes and fees, because they're easy to overlook until they quietly eat into your returns. In a taxable brokerage account, selling an investment for a profit can trigger a tax on that gain. Generally, investments held for longer than a year are often taxed at a more favorable rate than investments sold quickly after buying, which is yet another reason the buy and hold, rebalance occasionally approach tends to be tax-friendly compared to frequent trading. Frequent buying and selling can rack up short-term tax bills and, depending on your broker, transaction costs, both of which quietly shrink your actual take-home return. If you're rebalancing inside a tax-advantaged retirement account, this is usually much simpler, since buying and selling inside those accounts typically doesn't trigger a tax bill each time. That's one more reason to prioritize those accounts when you can. One more small but powerful idea. If you're rebalancing in a taxable account, you can often avoid selling anything at all by simply directing new contributions toward whichever part of your portfolio has fallen behind. That way, you're nudging your allocation back into balance without triggering any taxable sales, just by choosing where your next deposit goes. Let's bring this all together. Most investors don't underperform because they lack access to good investments. They underperform because of timing mistakes driven by emotion, buying after the hype, selling after the fear, and trading far more often than necessary. The fix isn't a secret strategy. It's a portfolio built from a few broad, low-cost funds, a target mix that matches your timeline, and a simple once-a-year rebalancing rule that quietly forces you to buy low and sell high without ever having to guess the market's next move. Pick your account. Pick your broad, low-cost funds. Automate your contributions. Set one rebalancing date a year. And then, honestly, the best thing you can do for your portfolio is check it a lot less often than you think. If this helped make investing feel a little less intimidating and a little more doable, consider subscribing for more videos that break down real financial concepts in plain language. No jargon, no hype, just what actually works over time. See you in the next one.